Restaurant owners, welcome to this week's Facebook Live training on how to use your accounting and finance to improve profits and cash flow. My name is Tim Cernett. I'm a CPA. I own Financial Optics, and we work with independent restaurant owners to help them utilize the accounting and bookkeeping as a tool to improve profits and cash flow. Let's get into this week's topic. Let me share my screen. There we go. And this week's topic is managing debt, moving debt from a burden on your business to a tool for your business. This is a quick 15-minute short guide on evaluating, restructuring, and strategically managing your debt for independent restaurant owners. So the hidden threat is that most restaurant owners, you're so focused on the day-to-day operations, meeting payroll, managing the restaurant, improving recipes, managing the menu, making sure the front of house is all good, ready to go to take care of your customers. Many times you're so busy that you're flying blind when it comes to debt until it starts to strangle your cash flow. So what you'll learn today is if you have current debt, most of us do, how to evaluate that current debt situation. Are you using the right kind of debt to finance different aspects of your operations? And then we'll look at restructuring techniques to improve the terms on that debt if you're not, in fact, using the right kind of debt for the different aspects of your operations. And we'll look at strategic cash flow management to control debt. So the opportunity is that when debt is properly managed, it becomes a powerful tool for growth rather than a source of constant anxiety. So understanding restaurant debt. There's good, the bad, and the ugly. Good debt is a debt that invests in return on investment positive assets, kitchen upgrade, kitchen equipment, strategic expansion, front of house upgrades, using debt to invest in assets that will improve your profits and cash flow, a return on investment. And are you using the right kind of debt to finance those assets in your business? The bad debt is debt that covers current operating losses, using lines of credit to cover payroll, borrowing to cover regular expenses, and things that you're borrowing are actually just masking cash flow problems. Then there's the really ugly debt, credit card debt, 18% plus APR. MCA, merchant cash advances. This is an evil thing. Do not get involved with MCA. Many times it could be as high as a 40% effective APR. And then there are predatory equipment leases where they make it sound all well and good. You're just leasing the equipment, and at the end of the lease, you buy out the equipment. If you do the math on it, it becomes sometimes even worse than credit card debt. So the debt trap is using short-term, high-cost debt for long-term needs, are continually rolling over bad financial decisions with bad debt. So those are the different types of debt. So evaluating your debt health. There's something called the debt service coverage ratio. This is a metric that you can do a simple math on. It's your EBITDA, or your net operating income, divided by your total annual debt service. That's the total debt payments you're currently required to make over the course of the next year. And so this is measuring, can you cover your debt from cash flow? And it should be a minimum of 1.5. That ratio should be a minimum of 1.5. Then we look at your monthly cash burn rate. Is debt fueling growth, or is it causing a slow bleed? How do you track debt payments to impact available cash month to month? Balance sheet red flags, growing liabilities with stagnant declining assets. Is that a trend? Vendor payables stretching beyond 30 to 60 days, especially with your key vendors, which you want to stay in good terms with your key vendors, and credit cards approaching their limits. So this is all part of the evaluation of your current debt health and your cash position projections. This is what we've talked about many times here in the weekly training, is an ongoing month over month detailed budget And when we do it for our customers, we include not just the P&L, the profit and loss statement budget, we do a balance sheet budget. So we're projecting out the balance sheet month over month over the next year so that you can visualize how debt payments are impacting your cash flow. This is going to become key when we start looking at restructuring your debt as well. So debt restructuring, we've evaluated your debt and we've determined that you have the wrong type of debt financing the different aspects of your business. So we can refinance high interest debt, trade volatile MCA loans or credit card debt with fixed term loans with manageable monthly payments. So these are debt restructuring strategies. And in the next slide, we're going to talk about where you can go to secure some of these new restructured debts. So consolidating multiple debts. Let's simplify it to one lender and one payment. If you've got 10 different credit cards and 2 different lines of credit, you're going to miss payments because there's so many things to juggle there. And when you consolidate with one lender or one payment, you avoid missed payments with high penalties and reduced financial stress. Navigate vendor terms. Extend net 50 to net 30 or 45 with key suppliers. Food distributors and linen providers often prefer to restructure their terms with you as opposed to losing a customer. So look at your key vendors. Just take a look at the volume of money you're spending with that vendor on the course of a year. If it's pretty high, if you're a 2 million, 2.5 million, $3 million a year restaurant, and 60% of your food purchases are with one key vendor, Cisco or whatever, whoever, and they have you on a net 15 or a net 20 terms, you can many times extend that to net 30 or even maybe net 35 or 45 because they don't want to lose you as a customer. You have buying power with them when you're spending that kind of money with them on an annual basis. And then thirdly, looking at SBA or equipment-backed loans, restructuring past mistakes, maybe you used credit card debt to finance the equipment purchase. Let's restructure that with an SBA loan to get that to a longer term debt to replace short-term chaos. So we're matching the life of the debt with the life of the purpose on the debt. A long-term 7-year debt to finance a new piece of kitchen equipment that you expect to last at least 7 years, or maybe a 5-year loan on a piece of kitchen equipment that you expect to last 7 years. So you want the term of that debt to be equal to the life of the asset or less than the life of the asset. So you're not continuing to finance something when it's extinct or out of service. So this is the hierarchy of how to restructure debt. You're going to refinance high interest debt with maybe longer term loans, consolidate multiple debts with one longer term loan, negotiate vendor terms, and then SBA or equipment-backed loans to use the right kind of debt to finance the right type of asset. So your allies in debt restructuring. Choosing the right partner is crucial for successful debt restructuring. And again, this is in hierarchy order. Local community banks, they're more flexible and relationship driven than the national banks. They understand the local market. They understand your impact in the local community and the importance of your business in the local community. They're often more willing to work with you, especially in some of these debt restructuring situations. Are you a member of a credit union? Credit unions want to take care of their members, and maybe you've thought about becoming a member of a credit union. Well, restructuring debt might be a very good reason to join that credit union. Now, they're going to want you to move your main operating banking to them, but if they're helping you restructure debt, that's well worth the move. They can give you better rates and terms compared to traditional banks many times. Online marketplaces. This is below going to your local community bank or a local credit union. These marketplaces are great, but they tend to be a little bit higher interest rate. So platforms like Fundera, Lendio, Funding Circle, they allow you to go out there and compare multiple loan officers from institutions that aren't necessarily familiar with you and your business, so they might be a little bit higher interest rate. Now, I put SBA 7A loans at the bottom because they're very restrictive and there's a lot of hoops to jump through to get those loans, but they are backed by the U.S. Small Business Administration. They can sometimes be ideal for refinancing high interest debt. You can get that lower debt. You just need to make sure your financial house is in order. You've got up-to-date financial statements, up-to-date tax returns, and you're willing to go through the process of securing that SBA loan. And it is many times very restrictive on what you can use those loan funds for inside of your business. Smart cash flow management for debt control. If your cash flow is tight because you're sort of drowning under debt, we want to go through that restructuring process. And during that process, we want to start to implement a 13-week cash flow forecast. That's looking out in detail over the next 13 weeks and managing that week-to-week cash flow. It helps you predict when debt payments are going to hit your account, and you're going to stay at least 13 weeks ahead in your planning. And many times we implement this 13-week cash forecast, and it starts to help you make the right decisions to improve profits and cash flow. It really drives that home and that focus home on making better decisions to improve profit margins, to improve cash flow with properly managing debt. Sinking fund strategy. Start to automate setting aside debt payments every week or even every day rather than scrambling monthly to meet those large debt payments. Now, this could be incorporated along with the 13-week cash flow forecast because you can start to visualize where debt is coming and you're planning every week to set funds aside to meet that debt. And the 13-week cash flow forecast will help you get ahead of the game so you're building a reserve that isn't fully utilized in paying debt, if that makes sense. Performance-tied payments. Use a percentage of net sales above break even, setting aside funds, that's the process here again, for making extra debt payments, reducing the principal, making principal-only payments on loans to extinguish that debt on a faster time frame than the life of the loan to help you get ahead of cash flow and start to build some reserves. Rolling monthly balance sheet projections. We already talked about this. Once you've done some restructuring, plug that into a 12-month rolling balance sheet projection and see how that impacts your cash flow and your debt reduction. And if you can visualize that vanishing debt, it will help you stick to the above techniques, to all these strategies for reducing debt. When you see that 6 months out, my debt's going to be so much lower, cash in the bank's going to be higher. It gives you that motivation to continue to make the hard decisions and do the work to manage your debt effectively. So avoid the Peter Paul trap. Avoid using one loan to cover payments for another. This creates the dangerous debt spiral that's difficult to escape unless it's one of your debt restructuring strategies, like using a longer-term loan to eliminate credit card debt that was used to finance long-term equipment purchases. So again, matching up the right kind of debt to the different aspects of your business. So turn your restaurant debt into a growth tool. Know what you owe and why, and analyze your current debt situation. Do you have good, bad, or ugly debt? Fix what's toxic by going through some of these refinancing strategies that we talked about so that you're aligning debt with cash reality. You're implementing weekly cash forecasting and sinking fund strategies and long-term cash flow balance sheet forecasting so you can visualize how these strategies impact debt reduction and cash in the bank. So if you'd like some more help on how to implement some of these strategies, or maybe just looking at your current debt situation and doing some analysis on that, go ahead and schedule your free profit and cash flow analysis with me. I'm going to leave a link to my calendar below in this video. I love talking to independent restaurant owners. I'd be happy to take a look at your current finances, and maybe we can strategize some things for you to not only reduce your debt, but help you improve profits, and cash flow. That's it for this week. Have a great Thanksgiving. Enjoy your family, enjoy the holidays, and we'll talk to you again next week.